Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Nina Mishra.
Hello and welcome to ETF Spotlight. My guest today is Matt Bartolini, Head of Spider Americas Research at State Street Global Advisors. Matt, thanks for joining us. Great to have you back on the program.
Yeah, great to be here.
Okay, so let's start with the market. So despite all trade and political uncertainties, stocks are close to their record highs. The S&P 500 index has gained about 19% year to date. But actually, most of these gains came earlier this year. Third quarter was pretty volatile, and stocks are now basically where they were at the beginning of the quarter. So what are your thoughts on the market's performance so far this year?
Yeah, I think year-to-date figures are a little clouded by the events of the fourth quarter of 2018. So I think everything broadly looks up, but when you extend the lens to take a one-year view, you start to see that we're still relatively flat on a year-over-year basis. In some instances, like with small caps and mid caps, and pretty much anything outside the U.S., still down on a year-over-year basis. But definitely risk assets have rallied so far in 2019. I think a lot of it has to do with basically the turn in interest rates. They've fallen basically 98 basis points this year alone.
Yes.
And that low-rate environment has pushed a lot of investors sort of further out on the risk curve. And you can see that when looking at things like high yield. High yield exposures are basically up almost 13% year to date. And this largely come from the spread compression because spreads have significantly narrowed as well, basically by about 166 basis points year to date. So I think from a market's perspective, it's looking as if we continue to have a risk-on rally. But when you sort of dive a little bit deeper, though, and go out 1 year further, and maybe look at some of the sector exposures, there's still a little of hesitancy in terms of if it's an all-clear sign in terms of the longevity of the current rally.
Yes, and talking about the economy, it appears that the U.S. economy is so far on solid footing, and that's thanks mainly to a strong U.S. consumer. And it seems that there is little risk of an imminent recession. But some of the recent economic reports have been rather lackluster. And it also appears that we are in the late cycle environment with flat or inverted yield curve and falling corporate profit margins. The Fed cut interest rates by 25 basis points at the September meeting, but there were three dissents. 2 for no cut and 1 for a 50 basis point cut. And this was the first time since 2016 that there were three dissents. So what do you think about the economy, and do you expect more rate cuts by the Fed this year?
Yeah, I think from an economy's perspective, investors have noticed that the U.S. is on a much stronger footing. So if we just even look at performance, so S&P 500 over the past year is up 2%, while basically EFA and EM are down 4% and 3% respectively. As far as sort of where we might be headed, I think we are now firmly in an era of monetary policy uncertainty. We were originally in a very certain monetary policy situation where we knew the Fed was going to be hiking rates, or we knew they were going to be on hold. But now we kind of have this sort of will they or won't they type mentality towards every meeting if they will cut rates. And I think looking at those economic data indicators, it definitely does not portend to an imminent recession, but it is a slowing economy. Things like jobless claims, consumer spending, credit conditions largely are still really supportive for the overall economy, but manufacturing continues to be very mundane and be in a contractionary phase. So I think that's sort of what the Fed is wrestling with. I think what may happen in the future, if we go fast forward to the October meeting, given that the September meeting happened right around the time the sort of repo madness was occurring, where we had funding issues, juxtaposed against some of the stronger economic data that still doesn't maybe portend to that imminent recession or sort of just continue slowing, I think October, there's probably a higher probability of a balance sheet expansion rather than a rate cut. And I think you'll probably see the Fed maybe lean towards expanding their balance sheet in October, which could be viewed dovish, just given the funding pressures out there, but also the impact on maybe interest rates. I think there'll be a little bit of a more wait-and-see approach to see if the cuts that they've made so far had trickled down to the real economy and start to sort of spur growth and inflation and mitigate any of the manufacturing declines we've seen. But honestly, it all comes down to what happens with trade. In the next few weeks, we're going to get some more details on the trade negotiations if tariffs have been further kicked down the road. But then there's also Brexit too.
Yes.
So the Fed is in a rock and a hard place, I would say, come that October meeting.
I agree with you. So I wanted to talk a little bit about sectors now. Technology is still the best performing sector this year, up about 29%. And healthcare is the worst performing. It's up just about 3%. And, investors love tech stocks and they continue to pour money into those high quality, highly profitable tech companies. But many of them are facing scrutiny from all angles now. So what do you think about these sectors? And healthcare, of course, has been a big loser this year, mainly because of regulatory concerns. So which sectors do you like now?
So with respect to tech and healthcare, I think it's pretty easy to say that both sectors are trading devoid of fundamentals. And it's interesting to see how headline risk has played more of a part in performance than anything else. If we look at tech, their growth projected for Q3 is negative, and I think they've gotten a recent reprieve on some of the trade-related tensions, which has added to their performance. If you look over the last 3 months, it's one of the better performing sectors. And also, when we run a simple momentum quant screen using 12 minus 1 and 6 minus 1 momentum, technology definitely fits in within the top 3. So I think the rationale for the strong returns and also from an ETF perspective, concerted inflows over the past 3 months has been that sort of momentum technical buying. As it continues to go up, though, the valuations start to become a concern. And that's why I think they're trading a bit devoid of that sort of fundamental aspect. But that micro sort of forbearance is really shown in the healthcare sector. So healthcare has been one of the more beaten up sectors over the past year and year to date.
Yes.
And it's expected to report the highest year-over-year revenue growth of all 11 sectors next quarter. And at the industry level, 5 out of the 6 industries are predicted to have really strong revenue growth, in some cases double-digit. And last quarter, 97% of healthcare firms beat earnings, and 60% saw their margins increase. That was the best out of any sector. So they have really strong earnings sentiment, some of the strongest out of any other sector, yet they rank the worst based on that same momentum screen, have had actually negative returns over the past year. That's actually created more of a valuation opportunity. When we look at a blend of 5 different valuation metrics, they actually screen as attractive. Actually, some of the most attractive sectors out there, just behind energy and financials, which have also been beaten up over the past year, but do not have the same earnings sentiment strength. I think the thing that's weighing down or an overhang on the healthcare sector has been the opioid crisis and regulatory pressures. I think the latter, though, is likely to not come to fruition, just given the noise, so to speak, coming out of Washington. There's a lot of other geopolitical tensions and news flow that might actually disrupt any meaningful regulation to come to pass. So I think healthcare is one of these areas that's kind of like a sneaky good contrarian type idea for investors that are willing to seek out those constructive valuations, but also the positive earning sentiment, but they would have to withstand some negative headline news from time to time.
And you mentioned energy and financials too, which have been beaten up this year. And do you think they are worth a look now, mainly because of their valuations?
I mean, with I guess the valuation aside, there's really not much of a catalyst. I mean, financials to some extent have been trading very much in line with the yield curve, and the yield curve is likely to remain somewhat flat, just given the the technical pressures on the long end due to the mundane growth and tepid inflation, if the Fed is able to steepen the yield curve, you could see a boost in financial stock performance, similar to value styles, which obviously banks and insurance companies are well populated within the value factor. I think energy has continued to be an area of the market that has some secular pressures given the migration to more cleaner energies, but also you're continuing to have ongoing geopolitical tensions fueling volatility in that space.
And within technology, is there any area that you like, or you think that the entire sector is overvalued?
Well, I mean, from a sector perspective, given how most of the sub-industries within it have traded in lockstep and have had strong performance and run-up in prices, the valuation case is hard to make on some of those. Now, having said that, there's still some areas within the technology market that are attractive based on some of the secular growth within them, and also their sort of lack of exposure to any trade-related tensions. So software services, internet companies largely have a smaller portion of their revenue derived from overseas, and there's obviously the underpinnings of ongoing software needs for companies to continue to add capacity to their business lines. So I think software and services is one of those technology industries that may be a bit shielded from any trade issues, but still offer that growth exposure to the overall tech sector.
And these are some of the areas that may continue to do well in the late cycle environment too, so they're definitely worth a look. Now, talking about other sectors, REITs and utilities have also delivered very strong performance this year because income-focused investors found them very attractive in this low interest rate environment. But I think they look a little bit expensive now. What do you think of these defensive sectors?
So purely from a quantitative measurement, when we look at that same value metric system that we discussed earlier, utilities definitely screen as expensive relative to the broader S&P 500, but also relative to their own history. Real estate as well, but not as expensive as utilities. And taking another view of it too, if we look for that hunt for yield that investors have been on, which have propelled performance for both utilities and real estate, and also inflows from an ETF perspective, and we look at its yield, the dividend yield for the sector over the past 15 years, and basically the current yield today is in the bottom 10th percentile for utilities and real estate. So that constant upward pressure from price momentum has pushed down yields to some of the lowest levels. And I think really what has driven those two sectors' performance has been sort of the double M, both momentum and macro. They rank very highly on momentum, and that momentum is being fueled by some of the macro sensitivities that those sectors have, particularly around interest rates. As interest rates have fallen, investors have sought out those bond proxies, and that has pushed prices up. And once again, similar to tech, trading a bit devoid of fundamentals, just based upon valuations. Investors continue to pay up for that macro-related exposure in a bond proxy conducive environment.
Okay, so in early September, we saw some rotation out of earlier very hot areas of the market into some ignored areas like small cap and value. But that trend did not last for a very long time. And you studied some of the factor trends recently. Tell us more about those trends.
Yeah, so in about the middle of the month, we saw a sizable rotation out of momentum and growth exposures into value. And that has led to value basically outperforming growth by about 3% this month. At the time though, around around September 16th, that month-to-date return differential between value and momentum and value versus growth were some of the largest month-over-month moves since the 2016 election. Basically, that move we saw intra-month was greater than one standard deviation of monthly returns. And I think the rationale for that sizable spike in value and the reduction in momentum returns has largely been attributed to short covering and de-risking crowded trades from hedge funds and fundamental investors, as well as the unwinding of bearish positions given the slight reprieve right around then of tariffs. And so what we saw was anything that was value-oriented, like dividend yield strategies, started to get a boost in performance. And I think the bigger question now is some of that reversal has abated as we came to the end of the month. It's definitely value's given back some of its gains. It's not as up as it once was, but it still is up higher. I think there are two things that could be a catalyst. One is a further relaxation of trade tariffs, basically a full relaxation where we get more of those tariffs pushed out, but also a steepening of the yield curve. We continue to see a steepening of the yield curve, which we did see this month, but basically coming off of a very inverted time frame. However, the interesting thing is that timing those two variables may be quite tricky, and the overall overriding economic environment is really not conducive for a persistent run in value stocks, just given that we are a late cycle and growth is really a premium to some extent. And typically value works well more in the early cycle part of an economy. So it's a little bit too early to tell, but if we continue to see positive performance, you might start to believe a little bit more on this value rotation.
Okay, interesting. So you also looked at global valuations, and you found that U.S. mid-caps are now exhibiting attractive valuations on both absolute and relative terms. And valuations of Japanese equities are the most attractive among all regions. Talk to us a little bit about that.
So, we actually have done quite a bit of research on mid-caps, not only just from a market perspective, but also a strategic asset allocation perspective. They tend to be really overlooked and under-researched, overlooked by the fundamental analyst community and then under-researched by academia. And we wrote a couple white papers about it, one really just showcasing the interesting return paths overall for mid-caps, which I think, the way to sum it up best is that if we look at Sharpe ratios going back to 1994 on a rolling basis, so 242 five-year rolling periods, basically Sharpe ratios for mid-caps were, in those periods, 58% of the time higher than large caps and 94% of the time higher than small caps. Yet investors tend to sort of overlook mid-cap exposures within portfolios. And right now, there actually can be a value opportunity case to be made, even though large caps screen as expensive relative to their own history. Small mid-caps actually screen as relative to both the S&P 500 and relative to its own history as somewhat attractive. So it's an interesting time for mid-caps, even just looking at performance. They have outperformed small caps in this period, where you would think that given sort of the risk-on feel, but although we've had some microbursts of volatility, mid-caps have outperformed small caps by about 2.5%. So it's an intriguing time. I suggest investors take a look at their overall mid-cap exposure, not from a tactical perspective, but also strategic. With respect to Japan, I think one thing is things might be cheap for a reason. I think Japan might fit into that camp, just given what's going on from an economy's perspective, or an economic perspective, I should say, where growth continues to be challenged and inflation continues to be equally as challenged. And the overriding catalyst for further price appreciation is low. But there's, for value-oriented investors, there can be some pain, and maybe that low valuations is worth it.
Mid-cap equities really surprised me that investors and analysts ignored them, though they have delivered very good performance over the long term, so they are definitely worth a look. You talked about interest rates a little earlier, and bond ETFs have been very popular this year with investors. They saw huge inflows, and that makes sense because about 15 trillion in government debt globally has negative yields now. So relatively, U.S. yields look very attractive, even though they plunged in early September before recovering a bit. So tell us more about bond ETFs, why they have been so popular with investors. And you also wrote about some of the myths about bond ETF investing. So tell us about them, and where do you see opportunities in the fixed income space?
Yeah, fixed income ETFs have been sought after. not only just this year, but for quite some time. But interestingly enough, this year, as we speak today, sort of at the end of Q3, fixed income ETFs are basically 8% higher than their record flow totals from 2017, that pace. So basically right now they've taken about $112 billion this year, really pushing their assets much closer to that $1 trillion mark in the U.S. It's already surpassed that $1 trillion mark globally. And I think there's some real reasons behind this continued interest. We always sort of refer to it as the 4 C's. Choice. There's a lot more choice within the fixed income ETF marketplace than there was, say, 10 years ago, where it was largely just a mix of treasury and investment-grade corporate funds. Mm-hmm. Now you have high yield, you have preferreds, you have bank loans, emerging market debt, different flavors of that as well, whether it's local or hard currency. But then also you have a very vibrant, active ETF market where you have a lot of strategies now that have identifiable 5-year track records, and some even more than that. So the choice has really expanded. I think the second C within this equation is cost. I mean, mm-hmm. fixed income ETFs are 25 basis points, while mutual funds are 66. So the cost is just much lower. And then we've seen different client types. You have ongoing interest from the baby boomer era going more into retirement, so the need for stable income and more ballast within portfolios. But you also have seen emergence of institutional investors using them within their own portfolios as cash equitization vehicles, or like within the insurance marketplace, really transferring some of those single CUSIP bonds into the ETF and receiving the shares back, basically consolidating their own balance sheet but still maintaining exposure, something that we refer to as transfer of assets, and that's become quite popular. The last one is around comfort, and I think this sort of speaks towards some of the myths. There's this misguided statement out there that ETFs, particularly fixed income ETFs, haven't been tested, and that clearly is just not true. We've gone through serious bouts of volatility. We've gone through very systemic risk events, particularly if you think about the taper tantrum, the U.S. sovereign downgrade, the high-yield energy crisis, the fourth quarter drawdown of 2018. And what I would say is, if people are concerned that if there's a run on, say, high-yield ETFs, which tend to be the sort of whipping boy in this argument, I would just say, well, look to 2018. High-yield ETFs lost about 35% of their assets, and there was no articles written about gating of redemptions or massive market dislocations. The ETF structure worked as intended, and investors were able to transfer risk in real time, transact on the secondary market between willing buyers and sellers, and the primary market was somewhat left unaffected by the transactions because only a small portion of secondary market transactions actually flow down to the primary market. And overall, the high yield market only actually equates to about 3% of the overall high yield bond market. So ETFs for high yield make up only about 3%. So it's relatively small market share. And I think that's just really something to consider, and we've written a lot about this because there's a lot of just misstatements around the fears of ETF liquidity and the impact on not only single stocks but on the broader bond market where, I think high yield is actually has the highest market share. If we look at something like, IG corporate, basically ETF AUM only makes about 1%. So it's a really small portion of the overall bond market, which is actually quite large when you look at the global landscape.
Excellent points. And again, 4 C's are choice, cost, clients, and comfort. So which areas of the fixed income market do you find attractive now?
So in our view, you should, in this type of market, let bonds be bonds. Mm-hmm. So something like an intermediate corporate bond fund allows you to seek out a yield of roughly 2.5%, but not to be overextended in duration. So we'd like to have conversations with clients about is do not take uncompensated equity or duration risks. So with an intermediate corporate bond, 1 to 10 years, you have a flat yield curve. You can benefit from sort of playing in the belly of the curve. Mm-hmm. Get that 2.5% yield, only extend about 4.3 years of duration. And if we compare that to the ag, the ag is 2.1% yield and basically 6 years of duration. So your yield premium duration ratio is much higher. And this is all framed around if you're sort of at your target weight in equities, but if you're underweight equities, seeking out credit positions to sort of take that equity risk, but in a lower volatility manner, in your credit side of the portfolio. And I think there's one area of the market that's intriguing, which is senior loans. I think a lot of investors have rotated out of senior loans given the floating rate nature and how the Fed is cutting rates. But I think most people will be surprised to see that in the senior loan market, you're actually able to get a higher yield today than you can in the fixed rate high yield. So senior loans have basically a higher yield than fixed rate, which can be beneficial to those income-seeking investors. So those are the two opportunities we see within the fixed income space, is really trying to not take uncompensated equity or duration risk if you are already sort of overweight equities. But if you're trying to express more risk on view, but in a defensive manner, you can do it also on the credit side of your portfolio with something like senior loans.
So another area that you have been writing a lot about is fees in the ETF world. And State Street recently cut fees on 7 SPDR ETFs and added them to the suite of portfolio ETFs. And talking about fee cuts, State Street was not very aggressive in this race to the bottom. Say until a couple of years back. But of late, I've seen a lot of fee cuts and dirt cheap ETF launches. And you have been trying to educate investors about total cost of ownership and how that should be included in the due diligence process. So talk to us more about that.
Yeah, so for fees, they're obviously very important. They're a part of the total cost of ownership, and that's the key word, is they're a part of it. We think, and obviously we do this with our actions because we didn't just launch new funds ahead of those fees. We actually restructured funds with existing assets and existing liquidity because we knew total cost of ownership was really important. So to have funds with identifiable trading performance during both periods of tranquility and volatility allows for the due diligence process to account for the trading activity or environment they may be acting in. So total cost of ownership is really important, and you can really break it down between issuer-related costs, which are things like the expense ratio, any portfolio management efficiency, so deviations from the benchmark, but then also securities lending. So what's the securities lending policy within the funds? Are you able to recoup a portion of the expense ratio to offset that? And then there's really investor-controlled costs, which are the bid-ask spread, but also commissions. And in our work, we've really made a concerted effort to partner effectively with certain platforms to offer a lot of our funds, including pretty much all of the SPDR portfolio series, all 22 of them are commission-free across multiple platforms to really reduce that total cost of ownership. So the fee story gets a lot of the headlines, and admittedly, I can understand why. Fees are a big part of it, but we also want to make sure that we're lowering the total cost of ownership for investors where possible, and really just making these ETFs efficient uses of capital allocation. So we've also had a consistent share price because we understand that there's a rise of more low minimum accounts for model portfolios, whether it's digital advice platforms or what have you. So making sure that there's a consistent share price allows for more efficient asset allocation based upon any type of capital that you do have, whether it's $5,000 or $500,000.
Great points. So switching gears a little bit, last week, the SEC approved a new ETF rule, and that is expected to greatly improve and simplify the ETF approval and launch process. And this new rule is expected to stimulate more innovation and also facilitate greater competition in the industry, and it will ultimately benefit investors. So what are your thoughts on the new rule?
Yeah, I think the rule, as it's put in place and structured, it does lower the barrier entry to firms. We've been very active in advocating for an ETF rule. We submitted a comment letter, and we welcome it. We welcome the competition, the more even playing field, and I think it's a really good sign for the industry, and it's opening up the marketplace to have a more consistent and normalized rule set for all issuers. I think that's just a good maturation process for the industry, and we welcome it.
Excellent. That's all we have time for today. Matt, thanks again for joining us.
Thank you.
Thanks for listening. To learn more about Spider's suite of ETFs and Matt's research, please visit usspiders.com. Make sure to be on the lookout for the next edition of ETF Spotlight, and also make sure to subscribe. If you have any comments or questions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.